Hello and welcome to the Junior Markets YouTube page. If you're tuning in from YouTube, make sure to check out our website, the Junior Markets website, because we're going to be going over 3 dividend REITs that you might want to see if you want to add to your portfolio that have constant dividends and some good upside. So if you don't know what REITs are, go to Stock Market under More Info, and we go over everything you need to know about REITs, some of the basic info, the types, why to invest, and what to look for when you want to see if you want to add one of these to your portfolio. So without further ado, let's hop right in. And the first one we're going to be going over is Realty Income Corp. So what Realty Income Corp is essentially they have about 15,000 properties, and most of which are single tenant leased retail properties. And they're leased to 250 tenants. Now, when you're looking at REITs, one thing to look at is tenants, because the more tenants, the better, because if they have a lot of properties like this one with 15,000, but only 250 tenants, if a few tenants decide to leave or if something goes wrong, then they can be severely affected. So that is something to look out for. But if we scroll up to the top here, we can see that Morningstar's fair value rating is $75 from the price right now of $62.40. So that is a nice upside. But if we head on over to Schwab's website, we can look at a few of the things that make REITs so attractive, and that is dividends. So if we head down, we can see that the dividend back in 2016 was $2.40, and it is $3.06 now, with a 3-year growth rate of about 3% and a 5-year growth rate of 3%. So they've been growing at about 3% for the past few years, which is above inflation. So that is something we'd like to see. However, the dividend coverage ratio is 34%. And this essentially means how much of net income a company has to take out to cover their dividends. But as we know, REITs have to pay out at least 90% of their income as dividends. So that means that this company pays out a lot of their net income as dividends. So if we go back, we can take a look at some of the metrics. So first off, if we head down here, we can see that their profit margins are about in line with competitors at about 18, same as everything else. Their return on assets is a little bit low, and their return on equity is also a little bit low. We'd like to see that a little bit higher. But if we keep heading down, we can see that their price to earnings is very high at about 57. Their forecasted is 48, which is better, which means their earnings are expected to grow. But their price to sales is also high, but all their competitors' price to sales are high. So that might not be something that's too big of a worry. And then if we keep heading down, something that's important to look at is sales growth, and the 5-year sales growth is about 25%, which is significantly better than all of its competitors. So it could be a good time to get in on this company. And then the earnings per share growth forecast is about 3%, which is in line, probably about the median with its competitors. So that's fine. And then if we keep heading down, their payout ratio is extremely high, like most REITs. And then their coverage ratio is a little low, so they have to pay out a lot of their net income. But that's like obviously like all the other REITs. And then if we head back over onto Morningstar, we can see that their total assets, which is important for REITs because they have to take on a lot of real estate property, is increased from 18 billion to 68 billion just in the past 5 years. And their liabilities have also increased, but their assets are significantly more. So that's something that we like to see. Their total debt is also not too bad for a company of this market cap. And then if we look down, we can go to cash from operating activities, which has significantly improved in the past 5 years, going up almost 2 billion, which is something we really like to see. And then their gross profits have also improved, coming from the past few years. It's gone up a lot. And then price to cash flow, if we look right here, is sitting at about 17, which has stayed stable about the whole time, which is about the industry average. So that's fine. Nothing too special there. And then if we get down into the ownership, we can see that a few ETFs and indexes have this in there. And then if we get down into transactions from insiders, we can see a lot of acquisitions. If we look in here, it's just a lot of acquisitions. And these are all pretty recent too, which is something that we like to see. We love it when insiders love their own business and buy a lot of their stock. So the second one we're going to look at is Vinci Properties, which is a very popular REIT. I'm sure if you're into real estate, you've heard of it before. Morningstar has their fair value at about $37 from the price of $33 currently. And what Vinci Properties is, if we head down to the bottom to the business description, they are a real estate investment trust. Obviously, they are a REIT. And they're engaged in the business of owning and acquiring gaming, hospitality, and entertainment destinations. So they're also subject to triple net leases. So I did a report on realty income on my website, and I go over what that is. So they consist of real estate properties like golf courses, a lot of golf courses, as well as the gaming. So if that's something you would like to diversify your portfolio into. And then if we head up, we can head straight into some of their metrics. So first off, looking at their revenues, just like realty, have increased greatly over the past 5 years. Their gross profit margin looks very healthy. It has increased. Their operating income has gone up a lot. Their earnings before interest and taxes has also continues to rise, even through COVID years, because these companies have to pay rent or receive rent, so they have more stable incomes. And then their assets have gone up significantly, which means they keep acquiring properties, which is something we like to see. And then their debt is going up too, kind of exponentially with their assets, which is expected because companies have to take on more debt in all different types of ways to help finance and buy all of these properties. And then the cash from operating activities also continues to rise. Their gross profit continues to rise. So that's something we love to see. Now, if we head over onto Schwab's website, we can look at their dividend. So it was $1 back in 2018, and it is $1.61 as of last year. And then if we scroll down, we can see that the dividend is $1.73 currently, and then it has a 5-year growth rate of 10%, which outranks inflation a lot, and their coverage ratio is well above 100%, which means they can pay out about 1.5 of their net income as dividends. So they're making more in net income than they're paying out in dividends, which we like to see. And then if we look into earnings, we can see that over the last few years, earnings have been a little spotty. They've missed on a few years. But for this quarter, they're expecting an increase of 21.64%, which is something that we like to see. And then if we go down to revenue or sales, we can see that the annualized 5-year growth rate is 32%, which is pretty incredible. And then same thing with cash flow, about a 37% annualized 5-year growth rate with constant increases, and it just continues to rise. So that is something we like to see. So with the secure dividend and increasing sales, increasing revenues, and increasing properties, this could be a good REIT to add to your portfolio. Now, the last one we're going to do is Triple N. And Triple N right now has a fair value of $49, and they're at $48, which isn't too much growth, but they do have a 1-star price of $53 and a 5-star of $45. So Morningstar is expecting pretty stable prices over the next 12 months. Their price to book is 2, which is fine, and then their price to earnings is 21, which might be a little high if you're looking at it, but it's a fine number. Their beta is about 1. All of these companies have a beta of about 1, so that means they pretty much move in line with the S&P 500. So if we move down, we can get a quick insight into what this business is. So there are a REIT, obviously, and they generate revenue from leasing properties to tenants, such as convenience stores, automotive services, fitness centers, theaters, restaurants, banks, pretty much everything you can imagine. And then they just collect rent from those from those owners. And then if we head up, we can look into some of the metrics. So their revenue, not exactly the biggest increases over the past few years, probably an average increase of about 6%. Their gross profit, however, just like everyone else, looks good. Their operating income does continue to improve with an average growth of about, looks like 60%. Their EBIT, their earnings before interest and taxes, also continues to improve. Their net income is going up at about a rate of 40%, which is something we love to see. And then if we head on down, we can see that their total assets continue to increase, not exactly at a big rate. They're not taking on a lot of new properties, but they are growing. They're taking on more debt, which obviously, like I said earlier, is needed to finance all of these new properties. So that is something we'd like to see because their cashes and their revenues are continuing. So that means that they can take on this debt. Their cash from operating activities also continues to rise. So that is something that we like to see. And then their gross profit continues to rise. Their pre-tax income continues to rise. So just all of their revenues and sales continue to rise. So if we head on over to Schwab's website, we can look at their dividends and their dividend security. So back in 2016, they paid a dividend of 178, and in 2023, it is 223. And then that is a 10-year growth rate of about 3% and a 3-year growth rate of about 2%. So it's about in line with inflation. Their dividend coverage ratio is pretty much 100%. So they're paying out most of their net income as dividends. But then again, most REITs obviously have to pay out at least 90%. Their dividend yield's about 5%. Their regular dividend is 58 cents. So it is pretty secure. Not really much to worry about. So heading down into some analysis, first up is earnings per share. And as you can see, earnings per share continues to rise. And for the third quarter of 2024, analysis estimate that Triple N will earn 50 cents, which is a decrease of 15% from the prior year. So that is something to look out for. But if we look down into revenue, we can see that there's about a 6% annualized 5-year growth rate and a 7% 1 year. So that is nice. And they have constant increases since 2021. And then also their cash flow has about an 8% annualized 5-year growth rate, which is something that we love to see. So what you're looking at with this stock is a stable, growing REIT with a solid dividend. It might not be the most flashy stock in your portfolio, but it will provide constant dividends over the coming years. So thank you so much for watching. Those are 3 dividend REITs that you should look into, in my opinion. And if you're wondering what REITs are, we go over it all in our website. And thank you so much for watching.